So hello guys, good morning, good afternoon, good evening, wherever you're watching me from. Um, this happens to be my first video on YouTube, but I'll also be dropping this video on Facebook, my Instagram page, my TikTok page, my Twitter page, and also on this YouTube channel. So I would want you to, through the link I'll be dropping, to follow me on Facebook, follow me on Instagram, follow me on Twitter, follow me on TikTok, and also subscribe to my YouTube channel, and also help me to share this video, comment on this video, and also like this video. um my focus this morning is on shares. Probably you've heard of the word shares, but then you don't have a concrete idea on what shares are. I'm just here this morning to drop this introductory video on what shares are. What are shares? Let me just read from an AI generated definition on shares. I need to put on my glasses to see this clearly. Shares are also stocks or equities representing ownership units in a company. When you buy shares, you become a part owner of that company, and your investment return depends on the company's success. Shares can be bought and sold on stock markets, and they can fluctuate in value. Yes, this is I'm so much impressed by this definition on shares by AI. I'm so much impressed. Simple, literal, no ambiguity, and it's also self-explanatory when you go through it, little by little. And by the way, when we talk about shares, we could also mean equities or stocks. So whenever I write on these things and I use the word equity or stock, just know that I'm simply referring to shares. These words can be used interchangeably. Okay, so you don't need to think too much on what stocks are or what equities are. They simply means shares. But just to digress a little bit, um, on what shares are and the features of shares. Number one is ownership. Shares represent a portion of the total ownership of a company. Yes, when you buy shares from a company, let's say a bank, it means you're one of the shareholders in the bank. And how can you be a shareholder in a bank if you're not part of the owners of the bank? To be a shareholder of the bank, for instance, I'm just using bank in this context, it means you're part of the owners of the bank. You may not necessarily be the one that started the bank, but then, you know, by virtue of you putting your money, into the bank by buying shares, it means you're part of the owners, in the bank. Number two, number two is raising capital. Companies issue shares to raise money to finance their operations, expansion on new projects. This is very true. This is not limited to just companies, even individuals, right? Let's say you have a business idea you want to implement, but then you don't have the money. You can talk to people you deem financially capable to help you with funds, right? Let's say you need about 10 million and then you have 2 million, and then you're able to find four people who can give you 2 million. That is 8 million plus 2 million, that is 10 million, right? And then you start up the business. But now these guys that gave you the money, or that gives you the money, they become shareholders in that your investment. But this is largely dependent on the agreement you had with them, right? It might be they might be giving you the money on the basis of them tipping you the money. They just want to dash you, in quotes, they just want to dash you the money, or on the basis of them borrowing you the money so that when you've gained your ground in the business, you can return back their 2 million, or on the basis of them becoming shareholders in your business, in investments you want to venture into. Meaning that when you start making profits in the business, they are entitled to profit from the business because they are shareholders in the business, right? They might not really be involved in the day-to-day activities of the business, but by virtue of them giving you money to start the business, they become shareholders of that business. Remember, this is largely dependent on the agreement you had with them, or you have with them, whichever case. The next one is dividends. If the company makes a profit, shareholders may receive a portion of the earnings as dividends. Yes, um, you wouldn't want to put your money into where you lose your money. I think every business person wants to put his money into where he's going to maximize profits. Same applies with buying shares, right? The profit you get from buying shares technically is called dividend, but you can also interchangeably use both words, dividends and profit. They literally mean the same thing, but technically, when you buy shares, that profit is called dividend, right? So when you buy shares I'm just using bank in this context because I really want to concentrate on buying shares in the bank. Mhm. When you buy shares in the bank, they are to pay you your dividend. Now, your dividend, like I explained before, is your profits. Uh-huh. And the next one is potential for growth. Shares can increase in value, offering potential capital gains for investors if they are sold at a higher price than they were purchased. This is just our usual buying and selling. If you buy a good for 10 naira, you wouldn't want to sell it for 10 naira, you wouldn't want to sell it for 9 naira. You want to sell it for maybe 10.1 naira, 11 naira, 12 naira, or even 20 naira, depending on the factors you're putting into consideration. So same applies here. Um, there's always this potential for growth. There should, not always, there should be this potential for growth in that particular business you want to buy shares into. The next one is risk. The value of shares can also decrease, meaning investors could lose money. Yes, I don't think there's any business out there, any investment out there, any company out there that is totally exempted from risk. I don't think so. Was it not last 3 months, Elon Musk, Tesla crashed, SpaceX crashed, and the man felt it. His stocks crashed. You can imagine if Tesla could crash, if SpaceX could crash, then I don't think any other business out there is exempted from risk. But the idea behind all these things is this: if you want to buy shares in a business, you should be very, very careful on the company you want to buy shares in. How do I really mean? Make sure that the potential for growth is bigger than the potential for risk. Yeah, you cannot really divorce growth from risk. You cannot remove risk from any business. You can't divorce risk from business. In fact, I think every successful business out there, every successful investment, every successful company out there, all undertook risk. The entrepreneurs who are the masterminds of these businesses undertook risk. They took risk to be able to thrive in the business they are doing now. So there is no business that is totally divorced from risk as it stands. But then the potential for growth of that business should be bigger, higher than the potential for risk, so you don't get to lose your money. So that is that for that on shares for now. But there are other things I would like to talk on. For instance, you might want to ask which is better: is it to have a fixed deposit account with a bank or to buy shares from the bank? Personally, I prefer to buy shares from a bank than having a fixed deposit account with the bank. But later on, in subsequent videos, I will give my reasons, and I would also want you to, instead of having a fixed deposit account with a bank, I would like you to buy shares from that bank. And many questions, when I post on my status, people ask me question: must I have an account with the bank? No, the answer is no, you must not have an account with the bank, but I will explain why and how to do these things in subsequent videos. So I want you to subscribe to my YouTube channel. I need you to follow me on Facebook. I'll be dropping my handles. I will need you to follow me on Twitter, on Instagram, on TikTok, so that you can also watch subsequent videos. And when I drop these subsequent videos, I'd like you to also share, comment, and like them. Thank you very much.